Okay, welcome to 3.13.2, additional methods for valuation of inventories. In 3.13.1, we talked about two primary methods of valuation of inventories that are often used today in business operations all around the world. However, in this particular subunit, very important and vital additional methods I'm going to deliver to you that you may see again on the CLEP exam. Okay, the first and foremost would be days in inventory, okay? So, what that does is actually measures the average number of days themselves before products are sold. So why would people care about that? Well, actually, it's another way to project when sales and how many sales could be made. For instance, regardless of the size of the business, but probably this would work better for small or medium-sized businesses. Take a small business, for instance. A small business may do a lot more business on Thursday, Friday, and Saturday. Let's say they're closed Sunday and Monday, Tuesday, and Wednesday. Depending on the product, they may not do a heck of a lot of sales. So they will know individually how many days in inventory that product will be. So they have to prepare for their largest days of sales, for instance, out of Thursday, Friday, and Saturday. Let's just say Friday has the biggest amount of sales. So Thursday you did okay, and now we may or may not, depending on other methods we can use simultaneously with this, may or may not want to replenish what's there. Odds are, based on the measurement, and we're talking about the median number, the average number of days before merchandise sells, we're probably not going to replenish it. It wouldn't make much sense to do so. So if we know Friday we're going to have a heck of a lot of sales, we're going to document that, see how it went, and wait for Saturday to see what goes on, because in that case, the end of our financial business week is Saturday night. Okay. Number two, inventory turnover. What is that? That's another measurement. It measures the number of times inventory completely sells per year. Okay? Now, this is a 365-day progressive method. So, once again, to reiterate, this inventory turnover, the turnover would be a year, and we're going to measure the number of times inventory completely sells per year. So, we have to make sure per quarter, let's take that scenario we used in 3.13.1, we have to make sure that out of 5 quarters, how many times did inventory sell out in quarter 1? How many times did inventory sell out quarter 2, 3, 4, and 5? And then we can compare year to year, quarter 1 to quarter 1 of the previous year, or for the next 5. We could forecast it. Okay, 2 big ones, very pertinent to your exam on the CLEP final. Often called FIFO, F-I-F-O. That's an acronym, and it stands for first in, first out. Now, it's drastically different than the latter that I'm going to talk to you about, so please pay attention. Now, what this does is takes the cost of inventory that we discussed before on the balance sheet. talking a lot about a financial statement, so let's make sure what we're correlating with what. The cost of inventory with the balance sheet, okay? And then it will represent the inventory most recently purchased. So if we have five days, let's just say we're open Monday through Friday, okay? The cost of inventory on the balance sheet represents the inventory most recently purchased. So on Monday, there were 15 purchases of whatever type of product we sell. Tuesday, 8. And let's say we're focusing in on Wednesdays. And let's say we're doing a ratio where using FIFO, we're concerned with Wednesdays because Wednesday, in this case, could be a high point for us during the week. It's our third day we're open, and it's third of the 5 days we're open during the week. So let's say it's a high point, and once again, we're focusing on Wednesdays. So the cost of inventory on the balance sheet represents the inventory most recently purchased. And if let's say we're talking about Thursdays, and we just opened, let's look at Wednesdays. So let's say every Thursday, we look at Wednesday PM, right? We walk in with our coffee all nice on Thursday morning. Hey, let me see the books. Let me see the receipts. How do we do on Wednesday evening? It's our biggest day and our biggest night. There you go. Most recent purchase right there, Wednesday PM. The other key with FIFO is the following, okay? The oldest items, and this is where it could get confusing. Oldest products are recorded first, okay? They're recorded first on the balance sheet. Okay, so number one, the oldest. Okay, very important. Now, it does make sense if you think about it. If you record the oldest items as sold first. However, the caveat to that, and where it could get confusing if you're not a good bookkeeper or if your accounting staff is not sharp, is that your oldest items are always recorded first. However, they may not have been sold at all. So these oldest items may never get sold, but we're still recording them first. So it's kind of an intricate system. It's the lesser of the two used, of the two that we're going to be talking about right now, this being FIFO, and now I'm going to go to the next. The next one's going to make a lot more sense because from a domestic standpoint in the United States, it's used the most. And that's called not FIFO, LIFO. Okay? What does that mean? Last in, first out. Nothing more than an acronym. But let's break that down like we did FIFO. Okay? Now, the oldest items were recorded first as sold in FIFO. Not the case in LIFO. Most recently produced items are recorded as sold first. Hence, the cost of goods sold would be highly attributable here. So this goes right into cost of goods sold. Okay? But most importantly, the most recent produced items are recorded sold first. Just the opposite in FIFO, okay? Now, one more thing I need you to know before we get to some bonus questions that I want to provide for you. In the United States, okay, it's GAAP approved, and for a multitude of reasons, it's no longer allowed to be used outside the United States. And as you may have heard before in our previous videos, which you should be watching, with LIFO, if you own businesses or have products that are outside the United States, that obviously fall into the category of inventory and you need to keep track of them, by all means, it would make much more sense to have either a separate staff that's versed in FIFO, where you can keep track of all inventory outside the United States. However, it's the opposite way of doing things as opposed to LIFO, because you're not allowed to use this method outside the United States, especially if you're doing business internationally. You have nothing to worry about if you're doing business domestically. You don't have to use it at all. But most businesses, medium to large, use these methods, and they're strictly attributed to inventory. So once again, can't be used outside the United States, would then have to use FIFO. So if you do see a question that has to do with geographic location and outside the United States, LIFO would not be the applicable method. But most importantly, let's just talk some basic jargon as it pertains to your first exam question in this area. So let me pose to you, in a period of rising prices, which of the following inventory methods results in the highest cost of goods sold? Would it be A, FIFO, B, LIFO, C, average cost, D, the periodic inventory, or E, perpetual inventory? Well, the key there is the inventory method resulting in the highest cost of goods sold, okay? Well, if most recent are sold first, that would be the key. And therefore, B, LIFO, would be your response. And one more exam question as a bonus for you. An inventory valuation method, such as FIFO or LIFO, will affect what? Okay, A, the cost of goods sold, but not the balance sheet. Now remember, I did tell you they will affect the cost of goods sold, but I don't think I discussed it not including the balance sheet. B, the balance sheet, but not the cost of goods sold. Just the opposite of what I just mentioned. C, both the income statement and the balance sheet. Well, I already mentioned that we're using the balance sheet, and you know we need the income statement to keep track of goods sold. D, neither the income statement nor the balance sheet. Doesn't sound too good to me. And E, the cost of goods sold, but not the income statement. That's a wash. So I'm going to go with C, both the income statement and the balance sheet. You may see that again. Good luck.